we are going to break down the smart money trading plan, a step-by-step guide supported with multiple real-time market examples. This strategy is divided into 3 main phases. 1. Examining the market structure. 2. Understanding the key concepts of smart money. And 3. Confirmation and execution. Now, let's dive into the concept. But before we proceed, if you find this valuable, make sure to press the like button. And if you are new here, don't forget to subscribe to our channel and turn on notifications, so you never miss our latest uploads. We will see you right after the intro and disclaimer. This trading plan includes 2 primary time frames. First, we use a higher time frame, in which we will do most of our general analysis. We will carefully read the market structure, direction, key levels, fair value gaps, liquidity areas, and, more importantly, optimal trading zones that might provide us high-quality trading setups. In the second part, we will zoom into the lower time frame and enter the positions. If we analyze the market structure and find optimal zones in the 4-hour time frame, then we will zoom into the 15-minute for entries. Similarly, if our higher time frame is 1 hour, then we will zoom into the 5-minute time frame for entries. If you cannot completely understand the steps, be patient. We are going to explore them thoroughly in depth with real-time market examples. Step 1. Analyzing the market structure in higher time frames. We have 3 types of markets in terms of direction. First, we have a moving uptrend, where price continuously makes higher highs and higher lows, breaking the structure to the upside. We want to trade with the dominant uptrend because it increases the chance of success. This process continues until we get a change of character, as it signals a possible reversal. Next, we have a moving downtrend, where price continuously makes lower lows and lower highs, breaking the structure to the downside. Once again, we want to trade with the dominant downtrend until a change of character occurs. Then the market sentiment will shift to bullish. Finally, we have a directionless market, where supply and demand are not strong enough to push the price into a directional trend. When we get a change of character continuously on opposite sides and cannot clearly identify the trend, we are in a directionless market. This trading plan is a trend continuation strategy, so implement it only when you can clearly identify the direction of the market. Step 2. Applying the key concepts of smart money. The first concept is the fair value gap. It is a 3-candlestick pattern with a significant gap between the shadows of the first and third candles. With no overlap, these gaps are formed when there is an imbalance between buyers and sellers. The market often returns to these gaps to absorb the remaining orders and restore balance. The second concept is liquidity, which acts as the fuel of the market. Liquidity areas are points where retail traders enter the market and place their stops just beyond these zones. For simplicity, let's focus on equal highs, equal lows, and recent swing lows. When the market captures these liquidity areas, the probability of success increases significantly. Optimal trading zones refer to areas where high-quality trading concepts converge. For example, on the 1-hour chart, we observe a moving downtrend. A considerable fair value gap has recently formed, and the price retraces to fill this gap before continuing in its direction. Now, where is the liquidity area? We know it lies at the previous swing low. Retail traders place sell orders here and stops above the zone, creating a cluster of liquidity at this level. And where is our optimal trading zone? It is the candle that generated the bearish inefficiency. We wait for price to reach this zone, then zoom into the lower time frame to seek confirmation and enter the position. Step 3. Finding confirmation and entry in lower time frames. We will now look into the lower time frame of the previous example and search for reversal signals to confirm the entry. To proceed, we must wait for a change of character, which verifies that the short-term trend has ended and the market can continue moving with the dominant higher time frame direction. We have 2 entry models. If the change of character forms a valid order block or fair value gap, we will place our sell limit at the beginning of the order block, with stops above the swing high. The second model applies when there is no order block or fair value gap. In this case, we will use the Fibonacci retracement tool, measuring from the start to the end of the change of character move. We will then place our sell limit precisely between the 0.618 and 0.786 levels. while applying the same concepts. Here is the checklist and key information about this trading plan. Risk 2 to 3% of your capital per trade. Allow up to 3 open trades at the same time. Stick to the trading plan and take positions only after successful confirmation. But remember, losses occur in every trading methodology. No matter what, losses are part of the game. Treat them as a fee you pay to the market. Thank you for watching. If this video gave you value, prove it, smash that like button. Don't just watch. Join the community by subscribing, and make sure you hit that bell so you're always ahead of the game. I'll see you at the top.